It could be about to get worse before it gets better. That's at least according to our next guest. Let's bring in Chris Harvey, Wells Fargo Securities, head of equity strategy. How much worse could it get before it gets better?
We think you have about 2 to 3% downside. What we see with Turkey, we see a crisis of confidence. And everything with Turkey could look good, it can look good, and then one day we come in and it gaps down. And with that, what we would expect is risk product equities to trade down with it. But it's not a seminal event. This isn't the systematic risk in the system isn't exceptionally high. And so we would think a couple things would happen. The buybacks, the breadth and the depth of the buybacks would increase on some sort of pullback. The fundamentals are still quite strong. When we look at the economy is as strong as we've seen it in years. GDP, it's only going to get better in the short term. And people aren't saying to us, oh my gosh, Chris, it's running hot. They're saying things are good and things are getting better. And that's what we see. And we see the same thing on the earnings side. Things are good, but they're getting better. It's not a house on fire, but when things come down, we like them more. When things go up, we like them less. You were talking about risk reward. When things come down, the risk reward to us looks better. And when we get closer to 2,900, the risk reward doesn't look as good. And so please.
So let me ask you then, let me push back and say, okay, we have emerging markets where the growth has been are starting to implode. And it's not just Turkey. It's multiple countries that are having higher currency problems. Even Italy with their higher yields today, people aren't talking about that. At what point does the magnitude, they all individually might be small, but the magnitude of all of them happening hurt the global economy, including the U.S.?
So one thing, and this is a theme we've been playing out for a long time, the market is becoming more discriminating. And so now, as QE painted everything with a brush on the way up, now that things are coming down, you have to price things based on their risk and on their fundamentals. Italy, Turkey, that's what you're seeing. You're seeing a differentiation. You're seeing a discrimination. And things that are good will continue to go higher. Things that are bad will trade down. So we don't think that emerging markets will bring things down. It was years ago where people would say, well, the U.S. market, that's the cart that everyone attaches their horse to. We still think that's true. And if you look at the banks, if you look at earnings, if you look at the market in general, it's pretty solid. I don't see a whole lot of risk in the U.S. market. Obviously, there is some, but the systematic risk is
but Chris, you just said
high.
that, this house on fire scenario for the U.S. economy, and we sitting here talking about whether the Fed is going to kind of scale back their expectations to raise, 1 or 2 times in the next few months. I mean, that doesn't sound house on fire. That seems like, all of this weakness underlying the major U.S. indices, which are the only ones in the globe that are basically up on the year. It seems like there is a pocket of risk that's being underappreciated right here.
Okay, so let's talk about the Fed. The Fed is moving at a very measured pace, and that's a good thing. The Fed is now talking about where their neutral rate is. So they're driving down the road and they're saying, okay, where do we stop? The Fed is also talking about pausing. That's constructive. And Powell has been doing a good job. Pockets of weakness, you're always going to get pockets of weakness. What we saw in earnings season is if you miss numbers, there was a big penalty for that. The market, again, is discriminated between good and bad. And I don't know how to put it any simpler. But when you look at the market in its totality, when you look at earnings, you look at the economy, you look at valuation, and when you look at sentiment, people aren't all giddy, they're not all excited, leverages, and there's not a whole lot of speculation, and usually toward the tail end of things, that's when you see that.
So this is a recipe for new highs by the end of the year?
So we think you go lower first, and then you do make good, better highs, or you make new highs. That is correct. Because of what we were talking about, because of the economy, because of earnings, because we expect M&A to start to kick in. If we look at the funding markets, we look at the credit markets, they're still wide open. There's still access to capital. When you don't have access to capital, that's when you worry. That's when you sell weakness. Not here, not now.
All right, Chris, good to see you. Thank you. Chris Harvey, Wells Fargo. What do you think?
Well, I wouldn't want to get overly bearish here, but there are some very big macro headwinds out there that I think the U.S. market has to adjust to. And I think that's the process we're going through. Well, I could see a scenario where we melt up at the end of the year. That's entirely possible. Sure. But before we get there, you just got to be cautious. Why are you buying the market here at all-time highs?
The 5-year average forward multiple on the S&P 500 is 16.2 times. We have $178 of S&P earnings projected for next year, and that may actually go higher. That brings you to 2885 in the S&P, which is higher than where we're trading right now. So from a valuation perspective, I don't think we're stretched out at all. I think you just selectively need to be there and buying stocks on dips that you find to be attractive names for the long term.
What did you do today, Karen?
I did a couple things today. I bought some Macy's, which I normally, when people really miss on earnings, I like to wait a couple of days, three-day rule. But I don't know, down more than $6 on what I really didn't think. That wasn't a disaster at all. Expectations were probably too high going in, so that was interesting to me. I also bought some BABA calls. I mean, that space has just got
ahead of earnings next week.
Yes, ahead of earnings next week. So that's kind of a much shorter term trade than I normally would do. But I mean, that stock is like the universe of those stocks there has just been obliterated. And I think the story is still very much intact. The valuation now is very different.
Right.
And then I have some S&P puts, and I will probably start to sell those tomorrow if we see any increase in the VIX.
Yep.